An FHA loan is probably one of the easiest loans that you can qualify for when you're trying to get a home loan. I think it's probably also one of the most popular, and the reason because of that is the low down payment requirements that you don't need to be able to purchase a home. This is the exact same route that I went down when I purchased my very first home, and I assume it's probably the choice that most home buyers choose when they're buying their first home as well. But having said that, with the recent pandemic and everything that's been going on, there's actually quite a few changes that have been made to the FHA loan program. And so I wanted to break those down and go over some of the changes that we've been seeing, because I can imagine how frustrating it's going to be or will be if you think you have everything squared away and then you make an offer on a house and then it turns out that you don't actually even qualify anymore to purchase the house. So I want to give you guys the updates, talk about what some of the changes are that we're seeing and what you need to know before you pull the trigger trying to buy a house. If you've been watching the news, which I'm sure many of us have, it does a good job at instilling a lot of fear. You really just don't see any good media anymore. But there's one headline in particular that really kind of struck fear in me. Was just a couple weeks ago, there's a headline from JP Chase saying that they're now only lending to people with a 700 credit score and a minimum of 20% down for the down payment. JP Chase is one of the largest, if not the largest, mortgage lenders in the United States. And so you know that if they're making all of these changes, if they're tightening their belt that much, you know that there's some kind of concerning issues, which obviously we know with the stock market and the economy and all those things that we're seeing. But if JP Chase is becoming that much more strict, then absolutely we have reason to fear. So now, after hearing that, if you're in the market to qualify and purchase a home, you may be asking, do I even qualify anymore if JP Chase is making changes like these? Okay, so let's dive right into it. These are the changes that we're seeing that have taken effect most recently with FHA loans. In the past, for an FHA loan, the bare minimum, the absolute lowest that you could have was a 500 credit score. And that's pretty low. And because of that, the down payment requirement was 10% down. If you could at least get up to a 580 credit score, then that would qualify you for the 3.5% down loan program as part of FHA, which most of us that's what we're familiar with, is the 3.5% down. Okay, so let me be clear. There's nothing that's actually changing to the FHA program. The thing that's changing are the lender requirements. So FHA has not come out and said, hey, you need this credit score. What's happening is FHA sets these requirements and the lenders do additional requirements on top of that, which we call overlays. They're saying, this is the requirement, this is the standard that I have to meet, but we're a little bit nervous right now, and so we're going to stack some additional requirements on top of that. I mean, this is really just insurance for the lenders. Everything is so uncertain right now. The outlook is not super positive. No one really knows what's going to go on. And so lenders, they just want to protect themselves. So will we see these get removed in the future? Absolutely. I'm almost certain that these will get removed. But right now, for the next year or maybe two, or however long this goes on, I don't know, those overlays are going to be in place. We're also seeing some changes to the amount of reserve requirements that you have to have in the bank. So before a lender will give you money for a mortgage, they want to see that you have enough liquid cash in the bank. They want to see that after everything is all said and done, when your loan has closed, they want to see that you still have some money left over for a rainy day or an unexpected car bill or medical bill or whatever it may be. They just want to see that you have a little bit extra cash. In the past, you've only needed 1 to 3 months of reserve. So let's say that your mortgage payment is right around $1,000. If that's the case, then the bank is going to be looking for anywhere from $1,000 to $3,000 cash in the bank after your mortgage is closed. Again, like I said, for that rainy day. So now banks have upped those requirements, and you're looking now for the 3 to 6 months in reserves, which that's kind of a lot of money. I mean, if we're going with $1,000, you need to have at least $3,000 to $6,000 in the bank as reserves for that rainy day. Personally, I think this is a good idea to have anyway. I think everyone should have that emergency fund just for things that do and will crop up. But this is going to be tough, because this is going to actually disqualify a lot of people from being able to qualify for a home loan. I remember when I bought my very first house, I had to have $4,500. I used an FHA loan, but I had to have $4,500 for my down payment and my closing costs. And if the bank were to come to me and said, hey, you need to have $6,000 just in savings aside from the money you're using to close on the house, I straight up just wouldn't have been able to buy a home. Back then, I didn't have that much money. And so, like I said, you're going to see a lot of people that are just not going to be able to qualify any longer because of those requirements. Okay, the other things that we're seeing is employment verification. Now, this is not new. Basically, when you go to qualify for a home loan, it's very common for your lender to call your employer. They want to just verify that you really do work where you say you work. There's a lot of people that actually put down fake employment to kind of fake their income, and lenders see past that. They call your employer to make sure you really do work there. This is nothing new. Nothing has changed with this. In fact, I bet, now that I think about this, I bet my employers over the years have probably been called a dozen times to see if I work there. And I don't know, I'm curious to see what the HR lady thought of, like, oh, maybe Bryce is going through some rough times or something. I don't know. She probably got called all the time with all of the different home loans and mortgages that we applied for. Okay, anyway, so things are changing now. And the thing is that whereas you only got called once to verify your employment, you may now have to have your employer be called 3 or 4 times. They may call your employer as soon as you open your loan application. They may call a second time 20 days before you close. They may call a third time 10 days before you close. And they may call again the day before or even on the day of closing to verify that you really do work there. The reason for that is because we have seen the unemployment numbers skyrocket exponentially. I mean, the graph literally goes like this. The numbers of unemployment have gone up so drastically that it's not uncommon for a lender to just verify that you still work there, because things change so quickly in 30 days. And the longer that this pandemic stuff goes on, the higher and higher unemployment numbers we're going to see. The smaller businesses, they're not going to be able to remain open. So again, lenders, they may have to call your employer multiple times. Okay, last changes that we're seeing are the ability to buy down points. If you don't know what points are, this is essentially just paying additional money, additional cash up front to get a lower interest rate. Let's say you don't have a bad credit score. It's kind of just in that medium range. Let's say you've got like a 625 credit score. You go and you try and qualify for a home loan, and they give you like a 3.5%. And, you know, a year ago, we'd be jumping up and down for interest rates like that. But today, 3.5% is actually that's pretty high. I mean, my wife and I were actually in the process of refinancing our home, and we just got a 2.75% interest rate. I mean, it's nuts. It is crazy. And anyway, so 3.5%, let's say they give you that. That's kind of high. You can actually pay, and it varies on lender, but you could pay, say, additional $1,000 up front, and then they might drop that from a 3.5 to a 3.25%. This is just money that you pay up front to drop that interest rate. It used to be that FHA loans were kind of like the way to go, just because they were so cheap. That was the way that you could get into a house for the least amount of money. But now we're seeing that switch, and we're seeing that they're actually beginning to become pretty expensive with all the points and fees and all the different things that lenders are charging, because they are more risky than just a standard conventional loan. Okay, so let's say you personally are in the market to buy a home right now. What should you do? What do I recommend that you do? First and foremost, I think what I can recommend the most is just say talk to your lender, and talk to them maybe not daily, talk to them weekly, talk to them very frequently. They're gonna have the most up-to-date information on all the different changes to the lending requirements. I know I was talking to my loan officer just 2 days ago, and she was telling me about some of the differences that they're seeing and the changes that are happening. But talk to them regularly. The reason for that is if you are shopping for a home loan, or you're shopping for a home, let's say you make an offer on a home. It would be awful for you to make an offer on a home and then you start going through the process of getting a loan, and you realize that you actually don't even qualify anymore and you have to back out of that deal. You can lose earnest money and all these different things. It doesn't look good. So go ahead and make sure that you are talking to your lender, making sure that you have the most up-to-date information. Or let's say that your credit score, it's kind of in that okay to good range. If that's you, maybe I would recommend just holding off maybe 6 months to a year before you start shopping for a home. Because of your credit score, your interest rate and your fees are going to be significantly higher than if you had had a good credit score. So maybe take the time to kind of take a step back, work on increasing your credit score, and then going back, starting to shop, work with a lender, all that kind of stuff. I think everyone's kind of in a hurry and a rush to buy a home right now because the interest rates are so cheap, they are so low. But the Federal Reserve has come out and blatantly said that they do not plan on increasing interest rates anytime soon. And I don't know exactly what anytime soon means, but I assume it's at least a year. I think it's going to take quite a while for our economy to recover, and so I don't see those interest rates going up anytime soon. So I think you've got plenty of time to take a step back, work on your credit score, and that's going to ensure that you get the best deal, the lowest interest rate, and the lowest fees when you do finally pull the trigger on a home. I hope this video is helpful, guys. I realize how frustrating it could be if you think you're ready to pull the trigger on a home and then you call your lender and everything has changed, all the rules and the terms and everything that you needed to do, you thought you were ready, it's all different. I realize how frustrating that could be. So I'm trying to give you the most up-to-date information that I know and that I see, but I promise that this is not going to last forever. This is just a temporary thing, but they will get better. Anyway, thanks so much for watching, guys. Appreciate you being here. If you have any questions, be sure to comment down below. Otherwise, I'll catch you guys in the next video.